to Mad Money. Welcome to Cramer. My friends, I'm just trying to make a little money. My job is not just to entertain, but to explain all this stuff, to teach it to you. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. When you want to buy a stock, you need an edge. It's never enough to just say, you know what? It's time to buy XYZ. I just feel it. Like the darn thing's a racehorse. and you don't even know how to read the racing form. There are all sorts of ways to get an edge. I love an edge. Maybe a quality stock's dipped because of an overall market decline. Maybe there's some headlines that were wrong. Maybe there's news that you think will be gigantic, but others don't realize it, and it pans out. Today, day where the Dow climbed 196 points, S&P advanced 0.27%, Nasdaq gained 0.37%. I want to talk to you about a new edge. A brief suggested by my friend Dave Kostin. He's the chief U.S. equity strategist at Goldman Sachs, and he's one of the most creative minds on the street. Now, I talk about Wall Street research a lot, and I have a history of carping about it, frankly, and you know what? That's wrong. Sometimes there's just great stuff out there that can really help you make a lot of money, like the stuff Kostin puts out. Kostin brainstorms and regularly comes up with some fabulous ideas that I like to incorporate into my thinking. He did it this morning in Squawk of the Street. That's what this is from. His stuff is essential reading. Today is this terrific piece. It's called The Fading Tailwind from Share Buybacks. I know it sounds, look, to me, this is like, it's prurient, it's whatever. The first paragraph carries the gist. Quote, S&P 500 companies repurchased shares at a record pace in the first half of 2025, but buyback growth has recently stalled, end quote, he tells us. Quote, S&P 500 buybacks in the first half of 2025 totaled nearly $550 billion, $490 billion net of equity issuance. However, buybacks in the second quarter of 2025 were flat year over year for the S&P 500, the Magnificent Seven, and the S&P 493, end quote. So buybacks, while strong in the first half, started to fade. They faded a bit last quarter. Buybacks are integral to the market because they act as what I call a sop. If there are lots of new shares added via IPOs, but not a lot of new money coming to the market, then it stands to reason that stocks will head lower. Look, it is just a question of supply and demand. Let's not outthink this. Buybacks drain the excess supply from the system. It seems they are draining a lot less than they were just a few months ago. Kostin has some great news here. While buybacks have slowed, investors continue to reward companies that aggressively purchase their own shares. And there's your edge. Stocks with bountiful buybacks can do well here in contrast to those that might not. It's an edge. It's not foolproof, but it's certainly an arrow in your stock picking quiver. And the market is so hard, you need things like this. Let's go to the next level. There are some caveats that he gives you. The one big beautiful bill will broadly help increase corporate cash flows. Positive. But Kostin's worried about surging CapEx, meaning companies spending on new plant and equipment. Now, I don't mind that, but you know what? I do want these buybacks to continue. Which brings me to the best part of this kind of analysis and the entire report. It's the introduction of Kostin's list of buyback aristocrats. Now, you might have heard about dividend aristocrats, which are companies that consistently increase their dividends for 25 years or more. Kostin's buyback aristocrats have reduced their share counts by 1% or more in at least 9 of the past 10 years. Given the throttling back of the buyback ratio, these stocks could rise to a premium versus the rest of the market. And Kostin's buyback aristocrats typically outperform when the economy slows. Hey, like we're seeing right now. So which of his buyback aristocrats are the best of the best? Now, this is what I like to do because I am a stock picker. I like to go through these lists, and there's a number of names of them, looking for stocks that I'm already a fan of that I think can go higher off their own fundamentals. Now, there are a whole bunch of characteristics that Kostin chooses to accentuate, but I'm gravitating to the column that highlights the average annual change in share count during the past 10 years. This is the hard part. In terms of just closing your eyes and buying stocks that have large share count shrinkage, DaVita's number one. Now, this is a kidney dialysis company that has indeed retired 9% of its share count annually for the last 10 years. That's big. But you see, it's not something I want to buy with RFK Jr. anywhere near the specialty medicine business. Second is eBay. Now, it's intriguing. Just put a good quarter. That is not enough for me because I fear the old eBay coming back. It has retired stocks at a 9% clip, though. Then up next is Synchrony Financial. That's a credit card issuer which has retired 7% of its shares per year. Tempting? No, because, see, I prefer Capital One, which said this very day that it's stepping up share repurchasing this quarter. Oh, and then there's another one. Don't tempt me. It's HP, the printer and PC company. That's bought back 6% of its shares on average. No thanks. See, it keeps missing the quarter. A buyback can't cover up these kinds of snafus. But let's cut to one that I am predisposed to. AutoZone, AZO, the auto parts chain, which does very well in a slowdown because more people want to fix up their old cars, save some money rather than have to go buy a new one. AutoZone's got a legendary buyback. I checked out the share count over the last decade, and it's astounding. 10 years ago, it had roughly 31 million shares, and now it's less than 17 million shares. That's what happens when you're repurchasing at a clip of 6% every year. I like it. Hey, then there's another one, Jabil, a contract manufacturer for tech and healthcare that's been sensational, buying back stock at 5% annually. That's one worth looking into. Why? Because Celestica, a competitor, is killing it. I'm filing it away. I put it away for another time. Now we got to go down to the companies that have been buying back stock at a 4% clip annually to find the two that I want to pound the table on right here and right now. Wells Fargo and Apple. Wells spoke today at a conference. I liked everything I heard. Here's what we told club members. Quote, Wells has bought back $5.5 billion of its stock so far this quarter. That's the most the bank has bought back in a single quarter all year. And by the way, that is a huge sign of confidence from CFO Michael Santomassimo, who said that he's seeing green shoots now that the Fed's removed the asset cap penalty on Wells. I'd be a buyer if we didn't already own so much of it for my charitable trust. And I know Charlie Scharf is on tomorrow morning. I want to listen to him. He's the CEO, and he's terrific. Then let's deal with the pachyderm in the room. Let's deal with Apple. All right, here's a company that's addicted to buying back its own stock. It's just a serial repurchaser. Sign that I think that management always thinks the stock is cheap, even if they don't come out and scream that. The timing here for Costin turns out to be impeccable. Better be lucky than good. You know why? Because today happens to be the launch of the new Apple iPhone, the 17. Thinner, better, stronger. The iPhone Air dazzled because of its thinness. There were price increases, not as noteworthy as I thought they'd be. They'll mostly be absorbed by the consumer, or in part because these phones are heavily subsidized by your wireless carrier. You just kind of don't feel it. Now, Apple's stock was down 1.5% today. Not unusual, as this has historically been a sell the news event. Sell, sell, sell. The stock's been down or just flat after this annual iPhone announcement in 4 out of the last 5 years. People left it and said, today wasn't the day. Well, it's not supposed to be. But get this. If you look at how Apple's done 1 year after the last 5 years worth of launches, it's rallied 13% on average, and it was up in every single one of those years. There are lots of people who care about how Apple has done over the last hour, 2 hours, or maybe how long it's taken me to talk. Some care even the next day. That's all nonsense. Let's make real money, okay? 13% in a year after new iPhone launch. That's what I call real money. I like Apple. I like those launch statistics, and now I have one more reason to tell you to own it, not trade it. Apple's buyback aristocrat status. Oracle's, by the way, booming tech report tonight after the close, one that swept up a lot of tech this evening, could help reverse the negative action on Apple. Why? Because there's going to be a big pin action trade for tech. I think Apple gets swept up in it. Let me give you the bottom line here. You need fortitude to buy stocks and to stick with them. Apple's buyback helps that fortitude. That year-long increase, wow, it's worth braving today's decline. Don't forget, AutoZone, Jabil, and the incredibly inexpensive Wells Fargo. Buy, buy, buy! Christopher in West Virginia. Christopher.
Booyah, Cramer.
Booyah, Christopher. What chicken?
Go Birds. Good win on Thursday night.
Go Eagles. Go Eagles. We got my man, the clog up in the center, Jalen Carter coming back. Had to pay a little bit of a fine there per game, but you know what? That's teaching maybe a lesson. What's going on?
Calling about a follow-up on Coca-Cola's Consolidated. When we spoke last time and you weren't a fan, I was seeing if we had a change of heart.
Well, see, here's the problem. Coca-Cola Consolidated, yeah, it's a bottler. It's good. But you know what? I like to buy Coca-Cola. I think James Quincy, his stock is actually coming down. It's now selling at a market multiple. Quincy's a really great CEO. It's one of the few consumer packaged goods stocks that work. That's my pick. All right, look, it takes fortitude to buy stocks and stick with them. It's really hard to make a lot of money in the stock market. Apple's a great little example, though, of what it's got a track record that makes it worth buying. after a launch and a buyback that makes it enticing for everyone. Only about time. Drone maker AeroVironment LAV reported after the bell, and I'm running through the numbers with the CEO. Then close viewers know I'm more open to speculation as of late. Well, certainly more than anybody else on TV. But some of the market's high flyers like Oklo, Rocket Lab have pulled back. So what should you make of that action? I'm going to go off the charts to see where we stand. And we are all about finding opportunity in any market. That's why I wrote a book about it. So tonight I'm covering an under-the-radar convenience store chain that you may not have heard of, but could be a winner for your portfolio. So stay with Cramer. What do we make of these numbers from AV, the drone-oriented defense contractor formerly known as AeroVironment? These guys reported after the close of the quarter was solid with better than expected revenues, bookings, and backlog. Management was also optimistic enough to raise their full-year earnings forecast meaningfully. Now, initially, the stock got hit in after-hours trading, which is exactly what happened the last time AV reported 3 months ago, before the stock went on to finish up more than 20% the very next day. And that was an incredible buying opportunity. Is it happening again? Just after the close, I got the chance to speak with Wahid Nawabi, the chairman, president, and CEO of AV, to find out. Take a look. Mr. Nawabi, welcome back to Mad Money.
Jim, great to be with you.
All right, so we got some work to do. Once again, Wahid, I remember if you, I don't know if you recall what happened when you were on last time. The stock dropped, and then 100 points were made after we really kind of straightened it out. Now, the headline numbers indicate 32 cents versus 35. You and I both know that is not an accurate depiction of this quarter. This quarter was an incredibly strong quarter. Could you walk us through why it's a stronger quarter than the headline numbers, which are not indicative of how you did?
Absolutely, Jim. You called it right last several times. I've been on your show for a long time. I can very confidently say that AV's prospects for growth and value creation has never been better. I've been here for 15 years, and it's been the best I've ever seen it, number one. Number two, why is there such a strong belief in that? Is that the need for the type of solutions that we specialize in and we are experts in has never been greater, never been greater. We have a national security priority and sense of urgency. It's supported by both parties, by the administration. We have conflicts around the world. We've worked really hard to put this company together to position us for this type of growth and prosperity. We have had an outstanding quarter Q1, nearly $455 million in revenue. We've got a $1.1 billion worth of bookings and backlog, and we've got $3.1 billion worth of unfunded backlog. These are contracts that are over time all going to convert and translate into funded backlog and revenue. These are the contracts that the customers have placed with us to allow us to actually deliver these systems to them over the next couple of 3 years or so. So fantastic quarter, launched a lot of new products. Very, very excited about the growth and the performance that we've done so far.
Okay, so it's really important for people to recognize that when we read these stories about how Ukraine's got inexpensive drones, that North Korea has inexpensive drones, or Iran, that the kind of thing you're working on, the anti-drone, comes in well underneath them and is more effective. Tell us how that project's going.
Absolutely. If you look at our portfolio, it's really unmatched in the entire defense industry, to our knowledge, to our experience. We make drones, we make counter drones, we make RF jamming systems against drones, we make directed energy and laser systems for that. We have space communication and lasers for that, directed energy. We've got loitering munitions. We have one-way attack drones, and we have the most prolific suite of software solutions that connects all these with AI and autonomy. And we just launched that product called AV Halo ecosystem. It's a very large and integrated portfolio of solutions that connects all these systems with existing legacy systems, as well as the future unmanned systems that are out there. So our solution set is unmatched in the industry. We have expertise in the industry and in the field. We've got decades of proven products in the field by the tens of thousands that are actually relevant on today's fight every day. And our customers are incredibly satisfied with our systems. And we have these pending threat with China, Russia, and other adversaries that's not getting better. And the U.S. is behind, and we need companies like us, AV, to step up and actually scale production, which we have uniquely the capacity and capability to do so as well. So those are the key reasons why we feel so strong about our business. And we've really worked hard to build this over the last decade to position us for such growth and prosperity.
No, we've been working together on this. I mean, the whole time I felt that the Pentagon was not in favor of what you were doing, because the Pentagon does favor manned missions, manned pilots, a whole suite of planes that cost hundreds of millions of dollars that can be shot down way too easily, unfortunately. So then we have to have triple redundancy, which makes it even more expensive. I prefer your method. It looks like they're coming around. Now, tell me about Golden Dome.
So we just announced a strategic partnership with Sierra Nevada Corporation, which is another very, very capable and very credible company in this area. That we actually put our teams together and invested our own funds, our own money, to develop a solution set that can address the Golden Dome demand and requirement and objective for the country. We have the pieces of the solution that allows us to go to our critical sites, and the government or our customers can actually specifically tell us which sites. And we provide a layered, limited defense solution set for those sites. We have the drones for surveillance. We've got satellite communication systems and laser communications. We have directed energy solutions. We have the software that allows us to track all these threats against hypersonics, against drones, against missiles. So we have the 80% solution today off the shelf without any additional investments from the government that we can go ahead and implement immediately. Right. We will even commit that we will take a contract to get a site up and running operationally and defend it and deliver on the performance specifications by the end of this calendar year. This calendar year.
Extraordinary. Now,
so I'm very excited about that.
Okay, now I do want to know about something that happened last weekend. We saw an attack. Russia hit Ukraine with the largest aerial attack in the war so far, which included, by the way, more than 800 attack drones. If you were there with everything you have, what could you have done to try to stop that attack?
Well, unfortunately, because of the sensitivity of this mission or these missions, I can't go into the specifics of that particular mission. Okay. What I can tell you, Jim, which is important, is that the solutions that we have will enable the United States and our allies to defend quite successfully against such an attack that happened in Russia with the Ukrainians. We have the technology today to defend our sites. That's why we feel very strongly that on a Golden Dome situation, and for that objective, we can implement that solution today with already developed investments that we've made over the last decade to protect our sites, to protect our nuclear weapon sites, to protect our forward operating bases, military bases, critical infrastructure sites. These are things that we have to protect. It's not a matter of when, it's a matter of when. The sooner we get on with this, the better. I commend the president for taking that initiative, the department for going after it. We're ready to actually help and deliver the solution and implement.
All right, one last question. I did want to ask about Red Dragon, because you have been saying it's designed to be mass-produced affordably. Those who think that we don't know how to make an inexpensive but terrific drone, they're wrong, right, given what I just heard about Red Dragon?
Absolutely. We have designed that product from the ground up to be not only low cost, but also mass-producible and also autonomous capable. So it could actually operate successfully in very, very contested battle spaces like the Ukraine battle space. This is a capability that we have today that we could scale. And it's inexpensive, it's affordable, it allows U.S. to have swarms of these by the tens of thousands against our adversaries all around the globe. It will give U.S. a competitive edge in the battlefield. And we need to act on these things, and I think I commend the department. The U.S. Army is taking very significant steps to modernize and transform, and we're talking to them and working with them. And I think solutions such as Red Dragon is going to be part of that solution set for the future.
Excellent. I want to thank Mr. Nawabi for coming on. And again, once again, the headline numbers are not how you should react to this stock. You should react to what he just said in this interview, just like he did last time when the stock then had a 100-point move. Don't be fooled by a headline writer number. Thank you so much, Mr. Nawabi. Good to see you.
Thank you, Jim. Great to be with you again.
Yeah, money's back after the break. lately, some of the hottest, most speculative stocks in this market have pulled back from their highs. And I think it's worth taking a closer look to see if they might be worth buying on weakness. Now, I'm talking about anything related to rockets, autonomous driving, nuclear power, the kind of unprofitable but high-growth stock that they've dominated for much of the year, but not lately. And that's why tonight we're going off the charts with the help of Bob Lang. Yes, Bob, the founder of ExplosiveOptions.net, as well as the author of Know Your Options. We're going to dig deeper. Now, personally, I'm a big believer in speculation. You know that, as long as it's done wisely, which means you got to take some profits on the way up. You got to know when to cut your losses when something goes wrong. But I bless it because so much money can be made. So let's go through the charts. Some of the biggest speculative winners of the year, most of which have now pulled back from their highs, with the exception of AppLovin, which made a new high today after we found out it was being added to the S&P 500 last week. We're going to start with one that I don't talk about. It's called Alster. And this makes 3D LiDAR sensors used for autonomous vehicles, drones, robotics, mapping, and defense. Something that's been described as physical AI. When you look at the daily chart, this one is one of Lang's favorites. Even though Alster has come down from its August highs, remember, we're looking at ones that have come off, he points out that the stock's still in a beautiful uptrend with a series of higher highs, okay, and higher lows. Meanwhile, Alster's volume trends have been incredibly bullish. It tends to have a higher volume on up days and lower volume on down days. For example, during the recent sell-off, we've seen very low volume. Now that Alster has pulled back to just above its 50-day moving average, right there, okay? Lang thinks you're getting a terrific buying opportunity right here, right now. What makes him so bullish? For starters, I want you to take a look at the on-balance volume line. This is down at the bottom. Okay, look at this thing, okay? This is a volume-based technical indicator that uses a running total of trading volume to predict price changes. Adding volume on up days, subtracting it on down days to gauge buying and selling pressure. Really cool indicator, frankly. And as you can see, Alster's on-balance volume has been exploding. Perfect. Even as the stocks come down. At the same time, Lang spotted signs of institutional buying. Plus, it doesn't hurt that Alster reported a very strong quarter with a healthy guide up last month. Of course, the stock is definitely not cheap. It has a history of being extremely volatile. But if Alster can rebound back to its old highs in the mid-30s, Lang thinks it could eventually run all the way to 45, maybe 50 by early next year. We've had a market that's been very friendly for speculative stocks. You know that. That's for most of the past year and really the last 5 years it's worked. And nothing's really changed. Alster's likely to remain a winner. This would be a good stock in my book, How to Make Money in Any Market. I talk about having a speculative stock. This would be the kind of thing that I would say, you know what, it's kind of off the beaten path, but it's going to be right. Next, all right, here's another one that's really interesting. Rocket Lab, with its lightweight orbital rockets. Now, here's the stock that spent most of the summer ripping higher after the company received a large grant from the government and had some successful rocket launches. However, the stock ran out of steam in July, and since then it's gradually come off its highs, mostly trading sideways for the past 2 months. This is this consolidation that sometimes I know that Bob likes very much. Of course, Lang puts out that Rocket Lab is still up roughly 220% from its April lows. It's rally that's mainly occurred on heavy volume. This is one of those stocks that's beloved by younger retail investors, although Lang thinks it's starting to attract interest from big institutional money managers too. He sees the stock's recent pullback to the 50-day moving average, sorry to use the shorthand, as another chance to buy the dip. And I know many of you probably think, dip? But in this world, in this speculative world, that is a dip. When you look at the action over the summer, Rocket Lab pulled back hard, then rebounded dramatically on high volume a few weeks ago before cooling off again. When you look at the on-balance volume, again, we're going down here, okay? And also the moving average convergence-divergence, which is right here, you get some really good buy interest. It is due, this is a $47 stock that could move above $60 in short order. I like that move. And you know what? If the Fed gets aggressive cutting a bit interest rates, all these speculative names are just going to roar higher. So let's think about Rocket Lab. That one looks very right. Then there's one that you know I like and I talk about all the time. That's Oklo. OKLO. It designs compact nuclear reactors that can be built more quickly. Everybody loves nuclear these days because it's the most reliable way to generate clean energy, and we are desperate for electricity thanks to the AI data center wave. As a matter of fact, it's the gating factor for NVIDIA. You need more power. That's why Oklo's had such a huge run from its lows in April to its highs in early August. Just take a look at the daily chart here. This is pretty amazing. We've got a series of higher highs and higher lows laying the groundwork for a classic uptrend. Even though Oculus pulled back from its highs, Lang points out that volume trends remain bullish, and the stock recently bounced off its 50-day moving average. You see this theme again? He loves it when it bounces off the 50-day, and then that's going to be a springboard. It's still down from its high, which is very unusual for a speculative stock. This could be well-positioned, even as you probably think, wait a second, didn't I miss it? That's not the way it works. Like the others, the on-balance volume here is solid, and it's trending higher. Meanwhile, the MACD line, look at this. We got a crossover right here, bullish crossover, where the black line crosses over the red. That's good. That counts. That counts. And that's one of the most reliable positive indicators out there. Of course, with the recent decline, Oculus now got a downtrend line in place. But Lang's betting the stock can break through that level, in part because, get this, the short interest in this one has gotten very high. People betting against it. Right now, it's about 15 to 17% of the entire float of the stock. When too many short sellers bet against these speculative names, the meme stock crowd knows that. They love to gang up on the shorts, as we remember from GameStop. It's relentless buying in order to break the backs of the shorts. Basically, Oculus is just under $74, and as long as it can get back above its previous high at 85, well, Lang says she got smooth sailing to the triple digits. Triple digits. All right. Now, finally, let's talk about the one speculative stock that hasn't cooled off at all, and therefore you may not like it that much, and that's AppLovin. The digital advertising play that we learned was joining the S&P 500 last Friday. This stock spent months rallying relentlessly to the point where it exploded higher yesterday and made another new high today. The last quarter was phenomenal. AppLovin's earnings should be more than double this year. I don't even want to tell you what I'm thinking about for next year. Though the stock's far from cheap at roughly 60 times this year's earnings estimates, it will turn out to be cheap if we do get the numbers that I'm thinking about for next year. Really interesting pattern here. I've been worried that AppLovin might pull back a bit now that it's finally added to the S&P 500, something that shareholder base has been predicting for months. But the darn thing just won't stop. Lang points out that we just got this bullish crossover in the MACD. This is one of the most beautiful crossovers I've seen. While the on-balance volume, look at this, will you, remains robust. Stock recently bounced very hard off the 50-day. Remember, I told you he loves a hard bounce off the 50-day. What can I even say about AppLovin? Stock was up 700% last year. It's now up about 70% year-to-date. Lang's betting it will keep rallying without looking back. I think this is a mini Google. Here's the bottom line. The charts interpreted by Bob Lang suggest that speculative stocks like Alstom, Rocket Lab, and Oklo can get their group back, while AppLovin is just going to continue to roar. I think he makes a very compelling case, although at the end of the day, speculative names do tend to trade together. But as long as the market remains friendly to speculation, these four are going to keep running. Just keep in mind that the market won't stay like that forever. But why not make the money when you can? I'm going to the show me state. I'm going to Jerry in Missouri. Jerry.
Hey, Jim, thanks for taking my call.
Oh, my pleasure, Jerry. What's up?
Jim, I don't understand why we are battling cybersecurity stocks. After last quarter's report, this cyber stock dropped significantly. Is the club's price target of $520 still valid on CrowdStrike?
You bet it is, and I think George is doing it. I'm speaking here of George Kurtz. There's a great interview, by the way. Yahoo Finance just tells you all that you need to know. I think CrowdStrike is I think it's a crouching tiger. That's what I think it is. And I'm thinking this stock is a $500 stock. That's how much I like CrowdStrike. All right, the charts as interpreted by Bob Lang suggest that these speculative names will indeed get their group back in short order, while AppLovin just continues to plow higher. What can I say? Just remember that the market won't necessarily stay this friendly to speculative stocks, but I got to tell you something. There's money being made. All right, much more made money had Casey General Stores has become one of our favorite under-the-radar growth stories over the past few years. And after reporting a top and bottom line beat, does the story still have legs? I'm going to give you my take. Hey, then Palantir changed the face of speculation in this market. I'm discussing its impact and how to size up the other potential winners. And once again, here comes Palantir. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Last night, we got the latest set of numbers from Casey's General Stores, which is a chain of 2,900 roadside convenience stores across 19 states, mostly located in very small towns. Now, I have been a big, unmitigated fan of Casey's for a couple of years now because they found this great niche. There's a reason this stock's up almost 2,400 100% over the past 20 years. These guys intentionally target smaller markets where their gas stations and convenience stores with fresh, hot food can become a big draw. And that's what's turned Casey's into a spectacular regional to national growth story. It's also, by the way, why the stock always seems to fly under the radar on Wall Street. Most people in the financial industry have never seen a Casey's with its stores mostly in the Midwest and Southeast. And they certainly haven't tried its absolutely fantastic breakfast pizza. They basically take this bacon, egg, and cheese sandwich into a pizza, and, well, you know what? It works. I tried it for the first time over the summer. It is legitimately great. And I'm from Jersey, where, I'm a Taylor ham guy. Now, the stock's now up 94%. 94% since I started pushing this thing 2 years ago, trouncing the S&P 500, which is why I keep going back to the well with this one. However, after the stock soared in response to earnings in early June, Casey spent most of the summer trading sideways. As we awaited the company's earnings last night, it was off about 10 points from its July highs, even as it was still up 30% for the year. That's one reason why Casey's initially got very little love after it reported last night. The actual quarterly results, they were excellent. Excellent. We're talking a healthy top and bottom line beat with 11.5% revenue growth as every individual business line came in stronger than expected. Casey's inside same-store sales were up 4.3%. Wall Street was only looking for 3.6%, with prepared food coming in much better than expected. For the fuel business, same-store gallons sold were up, interesting metric, were up 1.7%. The analysts were looking for 0.3% growth. We'll take volume growth any day when it comes to fuel. Casey saw some nice margin expansion, too, which is how the company could deliver a clean 75-cent earnings beat of a $5.02 basis. That's huge. It's nearly 20% earnings growth, led by the strength of their inside-the-store business, meaning the convenience store, not the gas station, meaning those breakfast pizzas. Same-store sales in prepared food were up nearly 6%. Wow. I mean, that's incredible. But that isn't just breakfast pizza. They also have sandwiches, wraps, wings, salads, fresh cookies. Cookies are very good. But CEO Darren Rebellis also called out, quote, positive traffic growth due to our summer merchandising plan, as well as our team's outstanding execution, demonstrating our ability to serve our guests efficiently at a high level, end quote. These guys mean this stuff. On top of that, he said that the company's fuel team, quote, did a tremendous job achieving same-store gallon growth while maintaining a healthy fuel margin, end quote. I know fuel team. Hey, listen, they got the best fuel team. What can I say? Thanks to the company's steady deliberate expansion plans, Casey's also benefiting from operating over 200 more stores than it did a year ago. Put it all together, and I think you've got some excellent numbers. Okay, all right, but there was one minor issue with the quarter, which is that management merely maintained their full-year forecast rather than raising it. And I've said that that's often a problem, but let's unpack this. For many on Wall Street, it's de facto guide down because they just reported better than expected quarter and they didn't raise their guidance to adjust. Specifically, Casey continues to expect inside same-store sales to increase 2% to 5% this year with the, quote, inside margin of roughly 41%. Same-store fuel gallons sold are still expected to be negative 1% to positive 1%. Total operating expenses are still expected to increase by 8 to 10%, and Casey's plans to open at least 80 stores in fiscal 2026 through a combination of M&A and new construction. This outlook was not necessarily disappointing on its own. It was totally in line with what the analysts were looking for going into the quarter. But given the Casey just reported a big top and bottom line beat for the quarter, it was a bummer when they left their forecast for the rest of the year unchanged. And that's why the stock got dinged a little bit at the opening today. Let's go through this. I wasn't deterred at all, viewing this negative response to Casey's overwhelmingly positive quarter as a potential buying opportunity for you, as I said on Squawk on the Street this morning when I was down. Why? First, let's tackle that unchanged guidance issue head on. While I obviously would have loved to see Casey's raise its full-year forecast, the company's only one quarter into its 2026 fiscal year. For most publicly traded companies, it's standard operating procedure to not raise their full-year forecast after just one quarter unless the numbers are insanely strong. On this morning's conference call, Casey CFO Steve Bramlage laid it all out. Quote, consistent with our past practice, we plan to update annual guidance on our second earnings quarter call when we're through the seasonally largest time of the year, end quote. There, he just said it, okay? A couple analysts tried to specifically suss out whether the lack of a guidance increase indicated any extra cost from Casey's management. The answer was basically no. Not really. Management simply reiterated that they'll provide an update on their outlook after the second quarter, which is the way they do it when there's, quote, more visibility into the balance of the year, end quote. Hey, that's fine with me, especially given the company's great track record. It should be fine with you. It's the chance to buy it without the what I think is going to be a guide up next quarter. Now, there was plenty of other positive commentary, too, because behind its folksy veneer, this company is a very sophisticated operator. For example, the summer merchandising effort I mentioned earlier was a true Casey's-wide team effort with coordination between, quote, supply chain and fuel teams and every member in between, end quote. And Rebel has mentioned that their data and insights, which are gathered from their nearly 10 million Casey's Rewards members, help inform merchandising efforts along with the company's pricing strategy and even decisions like bringing back a popular limited time only LTO barbecue brisket pizza, which I also had, and I got to tell you is... Pleasure. Management also said it's taking market share in fuel and it's doing so without sacrificing margins. I told you they had a good fuel team. It's all very impressive, and after this quarter, I remain very much in the bull camp on Casey's. And it seems like the market agrees. After trading lower for most of the day, Casey's shares did catch fire in the afternoon, rallying about 25 points in the final 2 hours of trading to close the day up almost $20 or nearly 4%. That's why that morning call was so important, okay? So here's the bottom line. Last night, we got another terrific quarter from Casey's General, one of my absolute favorite under-the-radar growth stocks. You could buy this one and put it away. While the stock initially did react because management left their full-year forecast unchanged, I think they only did that because they feel it irresponsible to raise their guidance after just one quarter, as many companies do. They don't want to get ahead of themselves. But everything's going great at Casey's, and the market eventually got this one right. Still, after today's gains, you know what? I think there's much more upside to come. Mad Money's back after the break. It is time. It's time for the light round. That's Rob from folks. Same as Doc said about my buys. But just got no core stock was instead. Don't mistake for the preference of how you play this out. And then the lightning round is over. Are you ready, Steve? Daddy, time for the lightning round. Let's start with Justin in Maryland. Justin.
Hey, Jim, how are you?
I'm good, Justin. How you doing?
Pretty good, pretty good.
What do you got for me?
So I was calling today because I want your take on mortgage REITs. With the potential of falling interest rates, I read that this benefits these
anyone
companies.
in particular?
I'm sorry, what?
Any mortgage REIT in particular?
AGNC.
No, I don't like agency. I think you're going to find over time you're just going to get your money. You get the dividend. You're never sure what they really own. It is not a growth vehicle. I like growth. Now we're going to go to Ian in Florida. Ian.
Hey, booyah, Jim. How you doing?
Booyah. I'm doing well, Ian. How about you?
I'm doing excellent, Jim. Thank you. Jim, I want to ask you a question about a stock that's really been beat up for a while now, but it's starting to make a comeback. What do you think about UNH here?
Okay, UNH reminds me, I don't want to say analogize too much to Google, but, you know, when the government gets involved, you do get very, very nervous if something's really wrong. But United Health has been going up. If there's something really wrong, I think the CEO at this point would have disclosed it. They did talk about the rankings today. The rankings are good. What can I say? I don't like to buy stocks that are under investigation, but it does seem to be that, well, I don't want to say the worst is over because it might not be, but there are some people who seem to know that the worst is over. How about that? And that, ladies and gentlemen, conclusion of the lightning round. For years, I've hesitated to embrace speculation on the show because so often the most beloved speculative stocks turned out to be nothing more than well-disguised pump and dump efforts. Sure, with the advent of meme stocks, you could own a GameStop or an AMC Entertainment, let others take you out higher. Although, to me, again, those seem like sophisticated pump and dump operations, too. But everything changed when the stock of Palantir arrived. The defense-oriented software company that relies heavily on artificial intelligence saw its stock rally from around $35 a year ago to $162 today on the strength of a series of very strong reports that vastly exceeded projections. Real stuff. I've been around for a while, and it really isn't easy to spot new patterns. But as I say in How to Make Money in Any Market, the speculative plays do deserve a place in your portfolio. One Palantir, which I continue to say will go above $200, can supercharge your entire returns, and not just for days or months, but even for years. When I saw the saga of Palantir unfold, I realized there had been a sea change in this market. A new cohort of investors welcome stocks with fantastic stories, and they keep buying those stocks for a long time after the news broke. Historically, good news would produce a ripple in a stock, but now it's a flood, and it's almost like an endless flood. After Palantir got hit with a host of spec stocks and blessed them all. There was Joby, the flying car company. It was in the sevens. I dismissed it earlier, but I discovered that Boeing's been working on a flying car, too. So who was I to dismiss the idea? The stock almost tripled soon after that. Then viewers urged me to focus on nuclear power. When I looked over the group, I found one that seemed like a serious spec, Oklo, which is building small-form nuclear reactors. Given the high demand for electricity, thanks to the data center build-out, which we heard just again tonight with Oracle, and the fact that Oklo is a company with significant customer interest, I decided to suspend my critical judgment. And I told you that it might take only one positive headline for this stock to rocket. Sure enough, a $33 stock gapped up when it was selected for a DoD contract. I don't think it's done going higher. Sometimes, though, you have a winner right in front of your face and you don't realize it. When I was at NVIDIA's big GTC conference in San Jose last year, I was checking out the booths of all those companies that were working with NVIDIA, installing product into the data centers, companies like HP Enterprise, Dell. And at the end of the hall, in what seemed to me to be a pretty empty booth, stood this company, Nebius. It's a data center builder like CoreWeave. I felt bad for them, like no one was paying any attention to them. So I asked what they did. I sauntered over there. They filled me in. They were going to be a part of the power solution. I thanked them, never really thought about it again. Until yesterday, when the company won a $17 billion contract to build a data center for Microsoft in Vineland, New Jersey, a town I knew well because my father took me there when I was a little boy when he sold boxes and bags to the retailers there. Sure enough, Nebius, which had been creeping up, vaulted from $64 to nearly $96 today in a colossal move. Nebius, it turns out, used to be a part of Yandex, controversial Russia story. Spun out from Yandex, Nebius is controversial no more. It's just electric, literally. And it reminded me that in this market, you better keep your eyes open for speculative stocks that work. There's lots of money chasing speculative stocks now, so when you get a good headline, you have no idea how high the stock in question can go. There's never been a market like this, people. It's certainly going much higher than anyone would reasonably expect. And that money can be yours for the taking. I'll like to say there's always bull market somewhere, and I promise everybody, just for your radio Mad Money, I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.